stability, and also to press on with the reforms under the structured dialogue platform for arrears clearance and debt resolution. So first, moving to the real sector, we see that Zimbabwe has reverted to a high growth trend after the weather shock of 2024. So our estimate for growth is in line with that of Government of Zimbabwe and the IMF of 6.6% for 2025. This is up from our initial projection of 6% earlier this year. And at that level, we see that Zimbabwe's economic growth is surpassing that of its regional peers. So it has a higher growth rate than Sub-Saharan Africa, but it also has a higher growth rate than that of Zambia, Mozambique, and South Africa. Now, what is making up this 6.6% growth? It's in large part by a big rebound effect from agriculture. And so here on the left-hand side, you see that maize was dipping quite significantly in 2024, and it is up about 200% since then. In addition, we see that tobacco sales have improved, and the amount of hectarage of tobacco has also increased. And finally, we also see that for wheat, there's a 20% increase compared to last year. Horticulture has not seen the same increase as previous years. So it's relatively flat. Then on the mining side, there's similar increases in performance, mostly driven by gold. So we've seen historic gold prices, and that has, because gold is by far the largest commodity exported, we also see that results in booming mining growth. On the other hand, we see platinum, group minerals, and chrome has been underperforming due to lower prices. Now, while the service sector as a whole is doing relatively well, we see that wholesale and retail is also growing. The one sector that we don't observe a similar dynamic is in tourism, where we see that growth has slowed a little bit in 2025, both a reduction in international tourist arrivals and bed occupancy. On the real side, another key point to emphasize this year is that Zimstat has completed a rebasing of Zimbabwe's national accounts, resulting in a significantly higher GDP estimate. So throughout 2024, they conducted an economic census, and they interviewed about 205,000 establishments. Out of those, they found that about 76% of all these establishments were informal, but they didn't provide a number of the share of GDP that's attributable to informality. So sometimes we hear 76% of the economy is informal. We don't know the exact number. We believe it's still somewhere in the area of 60 to 65%. However, the economic census was then used together with other administrative sources, particularly tax information, to then compute a new estimate of nominal GDP for 2024. And while their old estimate was 35 USD billion, the new estimate is 45.7 USD billion by 2024. And this is important because it shows that the economy has been growing, but it's also important because it affects some of our key economic variables such as tax to GDP and debt to GDP, which we'll see at later stages. So moving to the fiscal side. So here we see that the fiscal deficits in the last 2 years have been largely contained. For the year 2024, the government actually now estimates they've had a mild budget surplus. However, this does hide some of the buildup of domestic expenditure arrears, so the non-payment of suppliers that we saw throughout the year 2024. And if you were to have included that, then we would have seen a small deficit. For the year 2025, we're now expecting a deficit of about 0.3% of GDP. And moving to the debt side, we see that the total public debt stock has remained broadly similar in recent years. So we're now, our World Bank IMF debt sustainability analysis puts the overall public debt stock at around 23.7 USD billion, and that is up from 2023 in large part because of the additions of domestic expenditure arrears, which is classified as a new domestic debt. However, we see that because of the GDP growth, the GDP rebasing and a notable exchange rate stability, there's actually a major shift in public debt as a share of GDP. So our current estimates put debt to GDP at about 72% in 2024 and dipping to 49% in 2025 as a result of these three factors. Yet while debt has stayed relatively stable, we see that financing challenges persist due to the high cost of servicing public debt. And here you see that between January and June of 2026, the total debt servicing, so both the principal and the interest, was about 14% of total expenditure, which is more than all the amounts spent on primary and secondary education, more than is spent on lands and agriculture, and more than is spent on healthcare. Now moving to monetary and exchange rate discussion. So first I'd like to go through a discussion around the dynamics of the exchange rate. And here we saw that in previous years, in September, October, there was a big shift in the exchange rate as the Ministry of Finance borrowed funds from the Reserve Bank. And because the ZiG had a very narrow base, even a relatively small amount of borrowing had a huge impact on the exchange rate. So we saw that this led to an almost 40% depreciation of the rate. But what I want to talk about is what happened since that time. So after September of 2024, the Reserve Bank increased its reserve requirements, it raised its rates, and it maintained a stable monetary policy. And that has resulted in a very stable willing buyer, willing seller rate, what we call the interbank rate. So this has resulted in great stability of the formal rate, but most critically, it has also resulted in a stabilization of the parallel rate and an actual gradual appreciation of the parallel rate. And because of this, we see that the parallel premium has been declining and is now below 20%. So that's on the exchange rate. A similar dynamic then follows on the monetary side when we see on the inflation side. So we see that there was a big spike in inflation in September, October. But since then, and particularly since the year 2025, we've seen that inflation has resulted in lower single digits. And this has also had an impact on the annual inflation rate. So if you look here at the orange bar, we see that the ZiG inflation, year-on-year inflation in April was at about 85%. But after this, moving past this spike in September, October, we see a rapid decline in the inflation rate. And our expectation is that ZiG inflation is about 18% by year end, and USD inflation is around 12% by year end. So great improvement over previous years. Now, on the external side, we also see that the external accounts have improved quite significantly. So what is notable is that for the first time in a long time, there is a trade surplus. So you see here the dark blue bar, that's the trade balance, and it was in deficit in previous years, particularly in 2024 as a result of more food imports. But what we now see, because of gold exports and tobacco exports, alongside strong remittances, we actually see an increase in exports that exceeds that of imports, and a current account balance that has been growing year on year. So it is roughly, it's close to $2 billion now in terms of a current account surplus. Then we also see a similar dynamic on foreign reserves. So in the last 12 months, the Reserve Bank of Zimbabwe has been focusing on building up its overall reserves, and it now is roughly in the line of around $1 billion, which is at 1.1 month of import cover. This is still below the 3 months that is the standard for SADC, but it's moving in the right direction, if you want to put it that way. And then finally, normally at this time we also provide poverty figures. We're expecting some positive news from ZimStat here soon, from the preliminary findings from the 2024 Household Budget Survey. They'll be announced shortly, so we don't want to anticipate those remarks. Then, moving to the outlook, our expectation is that by 2026, growth will be around 5%, and this is in part because agricultural production will continue to expand, especially in maize and tobacco. We'll continue to see strong investments in gold, lithium, and in iron and steel. And this is one of the reasons why we've also seen strong manufacturing growth in this year. And we also assume that RBZ adheres to its current policy of tight monetary policy, moderating inflation. So there are risks to this 5% growth forecast. One is the possibility of climate shocks, even though so far the rains have been reasonable, but there's always a possibility that they will not be next year. There are fiscal risks, and here there are three main fiscal risks that we want to emphasize. The first one is the rising wage bill. So we see that the wage bill is currently expected to be about 53% of revenue, which exceeds the government's own target of 50%. And here we're hoping that the government can, we'll talk about the recommendations soon, but this is a concern. A second concern is on expenditure arrears, and so the not paying of suppliers. We saw that particularly in the year of 2024, that has increased. Now, fortunately, the government has annexed as part of last week's budget a domestic arrears clearance strategy to help gradually pay off some of these suppliers in the medium to long term, and also has some measures to prevent the buildup of future expenditure arrears. However, still an area of consideration. And the third here is around SOE losses. We saw in our previous public finance review that SOE's losses are a fiscal drag on government, and so this is another area to be considered to avoid these fiscal risks. Then there's always risks on the monetary side in terms of moving back to some of the old dynamics of inflation and exchange rate depreciation, but as long as RBZ adheres to its current policy, we don't expect any major shift there. And the final risk is declining global demand. And if there were to be a global shock, that can affect Zimbabwe's mining commodity prices and also risks geopolitical tension with potential trade partners. So to boost growth, we call on the government of Zimbabwe to continue focusing its current trajectory on macro stability, and also to implement the reforms under the structured dialogue platform for arrears clearance and debt resolution. And the economic reform matrix has 6 major items, and I'd like to now go through each one of these. So the first one is around successfully implementing an IMF staff monitoring program. You know that the government of Zimbabwe has formally requested an SMP, and policy discussions are continuing, and we're seeing them strengthening, so that we hope that in the near future, the government of Zimbabwe can agree on and successfully implement a staff monitoring program. The second, on the exchange rate. See that government of Zimbabwe has introduced their willing buyer, willing seller forex market, and critically, it's able to now fully meet the pipeline demand of those participating in the willing buyer, willing seller market. And this has been a particularly important reason why the exchange rate has stabilized in recent years. Now, there has been, as I mentioned, exchange rate stability in both formal and parallel markets, but the parallel premium could still go down further. And to do so our recommendations are to continue supporting currency stability and focus on reducing the parallel premium, potentially by expanding access to the willing buyer, willing seller market from the narrow set of banks and importers currently eligible to a wider set, but also to look at some of the structural impediments that are contributing to a parallel premium, including high bank fees for forex trade and for the intermediate money transfer tax that is also adding to a difference between the official and the parallel rate. Then on ending all quasi-fiscal operations, we
think that much of this work has been completed in previous years. So RBZ external debt has been taken on by the Treasury, it's being serviced by the Treasury, and RBZ cannot take on new external debt without explicit MOF approval. So here our recommendation is that there's a need to continue servicing debt exclusively through tax revenue and not RBZ borrowing. On revenue collection and expenditure management, we also see various tax revenue measures that have been introduced in previous years and in last week's budget, expanding the tax base and tax to GDP ratio. And here our recommendation is that we think that this is a move in the right direction, but more can be done to broaden the tax base, particularly around tax incentives, around mining tax administration compliance, and potentially the wealth tax. We also talked about the wage bill. So the government's own jobs evaluation report talks about potential redundancies and duplication in posts, and that provides a potential opportunity for limiting the wage bill going forward. And finally, in order to improve value for money in expenditure, there's also a need to build on recent initiatives around e-procurement and further scale that up across government. Then on maintaining tight monetary policy and sound fiscal management, we see that this budget, like previous ones, the fiscal deficit is within bounds, but the fiscal gap persists. And so here it's really key that on the monetary side, we maintain tight monetary policy, and on the fiscal side, we maintain a relatively balanced budget to avoid pressures to ensure that continuation of low inflation and exchange rate stability. And finally, we call for the improvement of access to inclusive social protection. So in order to make sure that any of these benefits from macro stabilization are broad-based, there's a need to strengthen the social protection system. And the World Bank has been working closely with government of Zimbabwe on developing this social registry system. It's currently live, and they're starting a pilot to expand it to 2% of Zimbabwe's population. But there's a need to scale that up further and integrate within government of Zimbabwe data systems nationwide. And finally, once that pilot is further advanced, there's also a need to utilize the social registry for all relevant government of Zimbabwe programs to improve the equitability of public spending. So with that, I'd like to thank you very much and open up for